Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We got 1 hour to go into the market close, so we want to take a look at the major averages. Of course, we continue to watch tariff headlines coming out of Washington. President Trump speaking a short while ago, signing a memo to study reciprocal tariffs, but not imposing any reciprocal tariffs today. And we're not learning anything about specific amounts of reciprocal tariffs, more just he kind of threw out some different industries that might be affected.
Yeah, it was reciprocal tariffs, friend and foe, could go big and broad, numerous trading partners, but that, I think you hit it, we're delaying implementation, right? It's not happening now. Now Howard Lutnick gets to work apparently, we're gonna negotiate, we're gonna talk. I think because this has been kind of the common theme, right? And we did have the 10% tariffs on China. Those are new and in place.
Right.
But besides that, we've had a lot of threats of tariffs, proposed tariffs, mark your calendar, maybe. And so at this point, I do think you have this common theme where investors are willing to look through it. Yeah,
so once we actually started hearing from Trump, we saw stocks sort of take a leg higher, especially the Dow up through about 0.75%, now 340 points. The S&P 500, similar, although less dramatic move of 0.9%. And the Nasdaq, again, similar, less dramatic move, not as many sort of large goods exporters, for example, up 1.25%. If you look at what's going on sector-wise today and see how it filters through that lens, we only have utilities very slightly lower. Material stocks are higher, maybe again some relief there. Consumer discretionary, tech, and consumer staples. Those are the four groups that are outperforming the S&P 500 today. Again, it seems like a sort of relief move.
I'm going to talk PPI, a little PPI.
I almost forgot about PPI.
Hotter than expected. The key there was, it sounded like quickly my inbox got flooded with economists pointing out, Julie, that the components, though, that fed into PCE, which of course is Jay Powell's preferred inflation gauge, rose much less quickly than a year ago. That is what the market seemed to seize on.
Right, at least for the moment. And then a quick check on large cap technology as well. Want to point out Meta, first of all, which is finally ending.
Look at that. It can go down.
After 18 straight sessions of increases. And Tesla, on the flip side, can go up for 2 days in a row, actually. It's up 5% today. It rebounded yesterday. So we're seeing it now up about 7.5% over the past couple of days. Nvidia also getting a lift here. Apple getting a lift. And so we're seeing some sort of chip stuff come out today that we're going to talk about later as well.
Green.
Well, President Donald Trump has signed his plan for reciprocal tariffs. Here with more, Yahoo Finance's Ben Werschel. Hi, Ben.
Hey, guys. Yeah, so I like memos to study for what it's worth. I think memos to study are doing that. But as you pointed out at the top of the show, this is kind of a plan to make a plan from Trump. We do have one concrete date here from Howard Lutnick, who has appeared with President Trump this afternoon in the Oval Office. He outlined how on the studies to look at this will be completed by April 1st. And then, as he put it, quote, we'll hand the president the opportunity to start implementing these on April 2nd. So what this lays out is kind of a further series of deadlines now on tariffs coming up. We have steel and aluminum tariffs that aren't going to be implemented until March 14th if President Trump goes through on that. We have the duties on Canada and Mexico due the start of March, and then this in April. So it's kind of setting up a series of sequences, but as you noted right at the top, are not going into place yet, other than these 10% duties on tariffs. On these duties announced today, what it does set up is a kind of series of countries trying to get out of it. The very first one we're going to see is India, literally within hours. Narendra Modi will be at the White House at 4 p.m. In less than an hour now to meet with President Trump, do a series of meetings, and then have dinner with him, as well as a press conference. So, and tariffs are obviously going to be top of mind there. India is one of the kind of the biggest targets for reciprocal tariffs, you would think, because they have very high duties compared to us. Others like Brazil and South Korea will also, I'm sure, be lobbying for this, for exceptions on certain things. But the question, Trump tried to downplay exceptions in his comments now, but it's clear that we have a couple months now of negotiations to see who these actually apply to in a couple months.
So Ben, just to make sure I am following the timeline correctly, my friend, the 10% tariffs on China, those are new and in place.
Yes,
but
exactly.
Everything else, we have dates on the calendar to watch for. Everything else that's actually in place right now are the tariffs that Biden kept from Trump 1.0?
Correct. Yeah. So Trump implemented a whole series of tariffs. Biden kept them in place. He added a few specific ones on things like semiconductors, which are all still in place for the most part. And then Trump has promised a whole bunch of these, and they're kind of signed executive orders or actions They aren't actually levying duties yet, other than these China ones you mentioned. China ones are happening. If duty comes in from China, if good comes in from China, it's charged as 10%. But all the other ones are sort of plans that Trump obviously could reverse, and he's using them as a negotiating tactic. So we'll see exactly, if I talk to you again in 2 months, how much is in place, how much isn't, which was very much to be seen.
Ben, great to see you. Thanks for helping us kick off the show. Well, for more on the latest Trump tariff news, let's welcome in Ben Emmons, Fed Watch Advisor, Chief Investment Officer and Founder, as well as Philip Luck, CSIS Director of Economics Program and Scholl Chair in International Business. Gentlemen, welcome to you both. Ben, I will start with you. Let's start with those tariffs, Ben. So a plan to impose these reciprocal tariffs on friend and foe could be big, Ben. Could involve numerous trading partners, but the key here, we're delaying implementation because now negotiations start, apparently. Your response and reaction to those headlines, Ben, as a market strategist?
Yeah, sure. No, this is obviously a tariff guidance that we're getting. It's like forward guidance from the Fed, right? It's sort of, we're going to implement these tariffs the next number of months, and all these conditions, well, some of the conditions outlined, they're going to be large, but nonetheless, it's a few months from now. So you're guiding the markets. And I think this is why the stock market rallied on this, because you're not doing it right off the bat here, unlike these universal tariffs that went into effect on Monday on China, which now will start to account for CPI reports as of next month. Right? We'll see an effect from that coming in. So I think the big reciprocal tariffs are just accepted by markets like, this is going to take some while before you actually can negotiate what the exact tariff will be, because you want to level the playing field here. I think that's really what Trump is ultimately after, which means that these tariffs may not be as high or maybe as low. Either way, it just not give you the reason to be risk off, rather to be more risk on.
Philip, I'm gonna get you to weigh in here on this whole concept of leveling the playing field, which is definitely how Trump has branded it. Is that what these reciprocal tariffs would achieve?
No, not really. I think it's an incorrect assertion that the level field is not the playing field is not level. Our current multinational tariff rates, as well as our bilateral tariff rates for free trade agreements, have been long negotiated over the last 70 or more years. We've gotten a lot of concessions for the tariff rates we have. I mean, to the degree to which the administration is worried about sort of our overall trade deficit, the fact that we import more than we export, this has far more to do with the fiscal account being, financial account being the opposite of the current account. We borrow more than we save. We borrow more than we make. The federal government has a lot to do with that, and that's why we have the trade imbalance we do.
Ben, back to you. I'm curious, Ben, how concerned you are about inflation after the prints we got this week, Ben. We got CPI, we got PPI, we got this constant drumbeat of proposed tariffs. How are you thinking about that, Ben?
Well, there's certainly inflation risk, and we saw it playing out yesterday in the markets, as in how the markets responded to a hotter CPI, because as much as you have statistical issues there, it does show that the trend is up quite a bit, particularly on headline. We went from 0.2 up, ratcheting up to 0.5. So it looks like an acceleration. And people are, again, to the guidance of tariffs, are trying to extrapolate what does this mean for next CPI reports. So yes, the China universal tariffs, which is not insignificant, like over 300 billion in goods, are going to start impacting the CPI data in particular. And inflation break-evens from tips, they trade off CPI. Treasury yields trade therefore off CPI. So there's definitely an effect there. I think we should be concerned that the acceleration is happening. What we saw today with PPI, maybe somewhat statistical too. The PCE data can be influenced by PPI. I would not expect that to be lasting though. So I think tariffs are here. They're going to start increasing prices, and it's going to already start increasing inflation expectations. So we would see some follow through on the actual inflation in the next few months.
Philip, what about you? What are you watching on the inflation front to see? Again, considering, as we've been talking about, that most of the tariffs are not actually in place yet, but do they still have that inflationary impact in anticipation of them?
They certainly can. And to your point about most of these not being in place, I'm starting to feel like Lucy with the football a bit, or every single day I feel like tariffs are going to come in and they don't. They absolutely can. I mean, firms are going to delay investments as a result of these tariffs. Firms are going to pass on price increases that they're expecting. Firms are going to change behavior, and that can raise prices even without the tariffs coming in by itself. I mean, a great example of this was when we put tariffs on washing machines in the first Trump administration, the price of dryers went up, even though the dryer didn't have a tariff on them. So you can have tariff effects even if you don't have, price effects even if you don't have tariffs on them. But I would say, I mean, the broader challenge here is going to be if we do have tariffs on, say, steel and aluminum that are universal, steel and aluminum prices are going to go up between 8 and 5%. That's going to have huge knock-on effects to industrial production further down the chain. So if these tariffs go on in a broad sense, we're going to see big increases in price.
Ben, bring you back in here. All this talk of tariffs, the proposed tariffs, Ben, that you keep hearing about, as a strategist, does it make you reconsider how you want to be positioned in the market?
Yeah, for sure, because what tariffs tend to do is create divergence between assets. You can already tell from the performance of European stocks to US stocks this year in itself. The tariff has, I guess, really driven the euro lower to the dollar, but it has benefited the European stock market as one reason. So I do think you want to play these tariffs with that sort of idea. Look for the opportunities where you get a bigger divergence between the US on the one hand and the other markets outperforming potentially. So diversification internationally, I think, is an important aspect this year for strategy, as opposed to previous trade war where it was very ad hoc and people took a negative for the global economy. I think people look back now to the US, like how will this really impact the US economy? Potentially a lot of uncertainty. I think therefore you get some outperformance in other markets, and that's your diversification opportunity.
And Philip, it's interesting what Ben is talking about in terms of U.S. competitiveness, its footing, indecisiveness. But I would imagine that other economies with which we have relationships will also see similar decisiveness issues. Like if I'm a business in the EU and I'm trying to decide on a spending decision and I'm an exporter to the U.S., it's going to be a tough time to make that decision. So how could this be viewed in terms of the global economic picture?
Yeah, absolutely. This is uncertainty that it's going to affect everyone. We're the largest economy in the world, and what we do impacts others. In addition to sort of how this might affect European firms making investments in Europe, one thing that I also note here is that, the administration is clearly trying to use tariffs for two different purposes, either sort of industrial policy to rebalance trade relationships, also as leverage to get things that are sometimes not related to trade. The point I would make is those two goals are very difficult to achieve at the same time. They're somewhat diametrically opposed. If you use tariffs for leverage, you need to have dexterity. You need to be able to put them on, take them off, increase them, decrease them as your partners respond. That's exactly the opposite of what you need to create a stable investment environment for firms to make investments here, moving their production to the United States, or abroad to support and to sell into the U.S. market. So these tools really can't be used together in a very effective way.
Ben, final question. I can't let you get out of here without a question on the Fed, Ben. It does seem like the Fed is on hold for the foreseeable future. I wonder, Ben, what you think that means for the market.
Yeah, that means that there's a possibility they could reverse course, meaning they're going to move from neutral to tightening. If we're going to get in an environment where inflation picks up more, in part affected by tariffs, either people front-load purchases and drive up growth and drive up prices, and or companies passing them through. I think that is one risk here building, because as much as we think they're going to be able to continue to cut rates, I think Powell was somewhat clear about these tariffs yesterday. Regardless of tariffs, inflation goes up, you got to use our tools. So we have to keep in mind that the Fed may be moving towards a different position this year if the tariffs are continuing to affect inflation.
Gentlemen, thank you very much. Ben and Philip, appreciate your perspective here. We're just getting started here on Market Domination. Coming up, weaker than expected guidance weighing on shares of Vertiv this week. We'll hear from the company's CEO on the other side about the path ahead. And after the closing bell today, it's another key round of earnings results. We'll get to the latest numbers from Airbnb, Coinbase, Palo Alto Networks, and even more. Stick around. Market Domination continues right after this. Big tech has been a well-known beneficiary from the AI boom. There's another noteworthy name gaining from the AI wave. That's been Vertiv, a maker of cooling systems for AI data centers. Well, shares of the company have been on a tear. Recent hurdles have weighed on the stock, including concerns over the company's growth outlook. Joining us now to discuss this and more, Vertiv CEO Giordano Albertazzi. Gio, thank you for joining us. And indeed, you guys came out with your earnings this week. You came out with your outlook, and the stock got hit here. And I know that the shares had been flying high into the report, to be fair, but what can you tell us about what you expect for this year and the pace of growth this year?
Absolutely. So let me start with one thing. Jerry, you were saying kind of a liquid cooling manufacturer. Liquid cooling is an increasingly key part of the technology portfolio. It's still a very small portion of our total revenue. We are global leader in critical infrastructure for data centers and telecommunications. We manufacture, produce, deliver, provide to our customers with the entire infrastructure, power, thermal, white space, the whole thing. So much broader than that. And think about only the power, critical power infrastructure is a third of all our revenue. That said, we just closed a very strong year. And if you look at our growth year on year, you think about revenue up about 18%, and our EPS was up a little bit more than 60% year on year. So quite strong. When it comes to the outlook for 2025. We had an investor day in November, and relative to that investor day implied dollar numbers, we have taken our revenue up. So I think all the signals are going into the right direction. Our trailing 12-month order growth for 2024 was about 30%. So serving an industry, the data center industry, majority of our revenue, that is certainly going in the right direction, and being a leader there position us very well. Then markets can be nervous, and we understand that, but we feel very good about our position and our trajectory.
So Gio, just to be clear on that, what you're saying is you are still very confident in those long-term targets, that 5-year financial framework you laid out for investors?
Very much so. Not only that, but we reiterated that message in the earnings call yesterday. So we see that the pipelines are going in the right direction. Our backlog creation that is higher at the end of 24, 30% than it was at the end of 23, all going in the direction of strengthening. Continue to confirm our growth and the value trajectory that we shared with investors. Very optimistic about that.
I'm curious geographically what you're seeing, because I know you talked about some weakness in Europe, and you all serve not just companies here in the United States, you serve them internationally, including in China and Asia Pacific more broadly. When do you expect Europe to sort of reaccelerate?
In general, well, first of all, we're saying that the biggest market is the Americas for us, and it's about 55% of our revenue. The rest is pretty much equally distributed between Europe, Middle East, Africa, and Asia. We see Asia quite vibrant in general. EMEA and Europe in particular are a little bit of a lagger in this data center build out, AI driven, for a good part, acceleration. So we always think about EMEA as lagging, say, 12 to 18 months, the Americas and certainly North America. And as we see North America drive, and we see that very publicly visible, and also the focus of many announcements in the recent weeks. Well, Europe is a little bit slower in that respect. It will happen. We like the pipeline that we have in EMEA, but it's taking a little bit longer.
Gio, President Trump making more headlines today with tariffs. I'm curious, how are you all, if at all, potentially impacted by tariffs?
Look, I think the best way to put it is we have been very focused on making our supply chain in general much more reliable, much more resilient in the last few years, and certainly with a focus in region for region. So we're proud of the manufacturing supply chain we have in the U.S. specifically, but it's early to say. I mean, as your interviews earlier explained, everything is so dynamic. So it's absolutely early stage. We have scenarios, we have playbooks in place, and but let's see what it exactly will look like before telling.
Gio, something else that there's been a lot of talk about in your industry is DeepSeek and the sort of idea that maybe not as much compute is going to be needed, or that the balance might shift. You guys talked about this on the call a little bit. Do you think that there will still be enough volume of demand in these data centers to fuel the same growth trajectory, not just for you guys, but for the whole industry?
The answer is yes. We believe that if anything, this DeepSeek and everything that is the discussion around that highlights the fact that, if anything, productivity is going to be injected in the whole process. I mean, we've been in this industry for decades, and productivity and efficiency have been a constant. So this is no surprise. If anything, this may make AI more accessible, and with that accelerate the demand. If anything, it could be an acceleration or a more rapid transition towards inference. So really the use of AI, and as that happens, certainly more infrastructure will be needed. So also what we saw from the CapEx declarations of many of the hyperscalers, there is no sign of abating in terms of the speed at which the industry is moving and building compute capacity. And we believe that will continue.
Gio, thank you very much for your time. Really appreciate it.
Always a pleasure.
Thanks.
Thanks a lot.
Now time for some of today's trending tickers. Shares of ARM Holdings rising as the company reportedly secures Meta as the first customer for its own chip. That's according to the Financial Times. Yahoo Finance's Dan Halley joins us now with more. Now, Dan, we should probably make clear to viewers, right? While we sort of refer to many of these companies as chip makers, ARM is more accurately a chip designer.
Yeah.
Normally, I guess until now.
Yeah, they're you would consider so chip. I guess chip maker is hard because they're not physically making the chips.
Right.
So it's I guess designer is more like accurate, whereas ARM isn't necessarily designing whole chips. They're designing different instruction sets for chips that can then be customized by these other companies, the Apples, the Nvidias, and whatnot. When it comes to their CPU in Nvidia's case. And so now they're actually going to be designing their own full CPU, so an actual full-on chip. And this is a big deal because Intel is the CPU company. And there's a reason why Intel's still doing its thing to a degree, whether well or bad, it depends on how you look at it, it's bad. But the thing that matters here is that Meta wants to use these ARM chips reportedly, this is by the Financial Times saying, in their data centers. And so that's a huge deal for Intel. Their chips are usually found in data centers. If you have an Nvidia card or a server in your data center, 9 times out of 10, there's also going to be some Intel chips in there somewhere if you're not using the actual Grace chips that Nvidia makes. So this is a huge problem potentially for Intel if ARM can go ahead and prove that their CPUs are powerful enough and efficient enough when it comes to performance. Because the big deal here that when you think of a company like Meta, they're using a lot of GPUs. Those absolutely hoover up electricity. Cooling them off is a big deal. So they're really just blasting through power. If they can find efficiencies anywhere, that's a boon to them. And if they can use an ARM chip, which are known for their efficiencies, then that could be a big, big deal for Meta when it comes to total cost of ownership of these huge data servers.
So what's interesting, Dan, in part what you're saying here too, is ARM now potentially comes into competition with some of its own customers.
But it's literally its own customers. I mean, look at, if you look at Apple, they're built on ARM chips. If you look at a number of these companies that use CPUs that are based on ARM technology. Qualcomm is one of the largest. They use ARM technologies. And so, if they're getting into the CPU space, that then becomes a problem for their own customers. I think it's important to point out that with the Meta distinction is, again, the data center. So it's not necessarily a problem for, Qualcomm there, really. Apple, obviously, they have their own data centers that they're reportedly working on using their ARM-based chips in, but that's going to be an Apple-specific kind of thing. It's not going to be a broader data center push. But when you look at something like an Intel and AMD, which is also in the data center space, not to leave them out, that's where I think the real problem is. And again, it comes down to the potential for that efficiency, because all we're talking about, I mean, they're building nuclear power plants, for God's sakes, for this stuff, right? If you can make it more efficient, that's a huge boon for them. So, I mean, if ARM can pull this off, it would be really, really interesting.
All right, big story. We'll keep watching. Thank you, Dan. Turning to Papa John's now, investment fund Earth Capital, backed by a member of the Qatar's royal family, reportedly looking at a takeover of the pizza chain. So this stock, look at that, up about 20% in today's trade, most since March 2020. Semaphore is the one reporting this, says the investment fund Earth Capital eyeing this takeover, the pizza chain, spoken with advisors reportedly about mounting a take-private bid for $1.4 billion for Papa John. Earth manages around $200 million. Sounds like we don't know how they would plan to finance a possible bid, but moving the stock. Sure.
Right, because it's not a huge fund. In other words, they already had a position in Papa John's, just under 5% that they disclosed last year. But they didn't, because it was under the threshold, they didn't have to give more information about what they were intending for the company. Papa John's, by the way, the stock has been an underperformer over the past year. Even with the pop today, it's down almost 28%. And so you could see why somebody would want to get involved here and make some changes at the company. So hence we see the big gains today on the back of this report.
Yeah, I've never had Papa John's, which isn't to knock Papa John's. I just live in New Jersey. It's a lot of the pizza.
I have had it, but not in a long time.
Yeah.
Because
there's
lots of local pizza.
It's a lot of competition.
The Senate confirming Robert F. Kennedy Jr. to lead the Department of Health and Human Services today. For more, we're bringing in Yahoo Finance senior health reporter Anjali Kemlani. So there's lots of implications, obviously, of this, both for publicly traded companies, for the health system in general. Where do you want to start?
Yeah, we'll start with the publicly traded companies. Obviously, we know the entire healthcare sector is going to be impacted by decisions that come down from RFK Jr. What we do know is that it seems to have been priced in. We aren't seeing any really major stock moves. We are seeing a little bit movement on HIMSS. We'll get to that in a second. But important to note that he did get this vote 52-48 with Mitch McConnell, Senator Mitch McConnell, being the only one to break from party lines. And he's a childhood polio survivor, so obviously has reason to look into the vaccines. Now, the vaccines being one of the biggest issues that is likely to flare up. We did hear during the confirmation hearings, Health Secretary Kennedy talking about how he supports the childhood vaccine schedule, but the questions about whether or not the rhetoric that he has had in the past is going to flare up and cause problems in the future. What decisions he makes about how research is done is also going to be a point to look at. So really across the board, some issues to look at there. Meanwhile, HIMSS, let's take a look at that chart because that company is up, popping today about 20%. If it still is, still more than that. So HIMSS has had an interesting week. Caught in controversy over its Super Bowl ad, which basically criticized the American healthcare system, talk about on brand with the political climate right now, and then followed by looking at pitching its compounded GLP-1s or weight loss drugs that it is selling through the telehealth platform. That's something that is a little bit interesting. We have seen that some of these drugs are coming off the shortage list, so that is creating some concerns about whether or not companies like HIMSS as well as Roe are going to be able to continue selling these compounded drugs moving forward. We did get some notes, one from an analyst or healthcare expert, Jared Holes, talking about how the RFK-led Health and Human Services Department will take a fairly lenient stance with respect to GLP-1 compounders. And this incoming administration appears to be very focused on cost benefits. So it could take a different stance. It could keep these drugs on shortage lists. It could allow them to continue, like, wild, wild west in that era. But we will definitely see. Meanwhile, just recap quickly back on Kennedy, just to note that pharma, one of the biggest lobbying firms, is going to be chaired by Pfizer CEO Albert Bourla this year. So that's going to create a very interesting relationship on vaccines and anything else moving forward. So
very interesting.
Stay tuned.
Thank you, Anj. Appreciate it. Coming up, shares of Ben & Jerry's maker Unilever are melting today. We're going to get you the latest scoop on the stock when market domination returns. That's a lot.
Just a couple of hours ago, cybersecurity company SailPoint Technologies began trading on the Nasdaq after pricing its IPO at $23 per share, raised about $1.38 billion in that IPO. SailPoint, one of the first big tests of the IPO market in 2025. It is expected to see an increase in activity as companies bank on a friendlier regulatory backdrop under President Trump. Joining us now is Tommy Ruger, UBS Investment Bank Global Co-Head of Equity Capital Markets. Thank you so much for being here.
Thank you for having me.
So we had SailPoint today. As you pointed out to me, we had a company called Carmen also coming out today. Yep. And I was looking at some data from Renaissance Capital that there were about 17 IPOs in January. They raised about $3.8 billion. And I feel like I've been hearing for so long, like we're waiting for the unlocking of the IPO market.
We are.
And it's only kind of come in fits and starts. What's going to be the key, finally?
Well, a couple of things. One, 2022 and 2023 were anemic in terms of the overall new issuance environment and IPO activity. So 2024, it was nice to actually see some increases in activity. We doubled the number of deals that we did in 2023. The amount of proceeds that we raised were more than double. And so we started to see some real momentum as it related to both activity on the issuer front, but also seeing good follow through on the buy side. The setup as it relates to the broader market also is conducive, right? We've got a strong economic backdrop coming out of the fourth quarter earnings, seeing over 10% bottom line growth. The economy is in a good spot, and we're seeing that reflected broadly in the equity markets as we look at index performance, implied multiples, et cetera. With that, though, we've had a little slower start as it relates to the overall IPO activity and broader new issuance. A lot of that has to do with some of the uncertainty that continues to remain out there, whether it's the current rate environment, whether it's tariffs. It's hard for many management teams and boards to feel confident about pushing forward with an important transaction like an IPO. They're looking for more certainty, and so is the buy side, for that matter. I am optimistic as we continue to see more certainty, as we continue to see more deals come to the market and hopefully provide strong returns for investors, we'll see an uptick in activity. We're seeing the early stages of that. A lot of companies preparing to look to go public later this year, whether it's the second quarter or in the second half. So despite the slow start to the year, I do think we'll see accelerated new issuance activity through the balance of the year.
Tommy, one other, just to get a kind of viewpoint there was a venture investor on the show, well-known guy. He was on in September. And I asked him, what's your outlook for 2025 for IPOs?
Yeah.
Not great, he says.
Yeah.
No fireworks. I'm not excited.
Yeah.
There's going to be nothing to see here. Then he comes back a few weeks ago. Totally different view.
Interesting.
Again, I'm excited. I think things are happening. I said, what changed? He said, Trump. I am curious how much that election result and this bet a lot of people have that you're going to have this just friendlier regulatory backdrop, how much does that factor into your outlook?
It's important as we think about certainty, as we think about confidence. I was down at our financial services conference down in Florida earlier in the week where we had executives from the largest financial institutions across the globe. The level of optimism and confidence is growing significantly. You could hear it in terms of their voices and their comments. Their expectations around uptick in capital markets activity, uptick in M&A activity, all of which is constructive as we think about an IPO market. All are positive signs. I do think from a venture perspective, given the current rate environment, it's going to be harder for some of the smaller cap companies, oftentimes there are venture backed, to get to market. I think you're going to see larger companies, primarily out of financial sponsors, scaled assets, profitable businesses that don't necessarily need to go public. But financial sponsors need to start the liquidity process and returning capital to LP. So those are going to be some of the first deals to market, larger businesses, larger offerings, more liquid. And my hope is with strong performance, you're going to see that ultimately trickle down to some of the mid-cap and growthier names that we're expecting.
Can you talk to us about any names that you think that maybe will finally come public this year that we've been waiting for a while? Like,
I'm getting the head shake.
Stripe, Databricks, Klarna, are some of these guys going to finally come to market?
I sure hope so. Look, my expectation is you'll see some of the names that I think have been bannered about in the media for some time ultimately decide to come.
If not names, Tommy, if you see this uptick, would there be sectors where you expect to see? I would expect to see more here in tech or healthcare.
Listen, I continue to believe that tech, healthcare, consumer, financials as measured by fintech, I think you'll see some activity across those sectors as well. Industrials was a sector that was very strong in 2024. We expect to see more activity in the industrial sector as well in 2025. So I think it'll be broad, which is actually representative of a healthy market backdrop and environment.
I'm also curious what you think the investor appetite is for new issues. I mean, in the investors generally that we've been talking to recently, they feel the tone feels a little cautious at this point. Part of because of some of those macro uncertainties that you were talking about. But do you think retail and institutions are going to come out strong? I mean, SailPoint today is not a great example.
Listen, I don't think it's appropriate to measure success or failure of an IPO and a public company in its first day of trading. There's a lot that goes on.
That feels very well practiced, Tommy.
I've said it once or twice over 26 years. So let's wait and see before we judge success or failure there. I mean, you could flip it on the other side, and Carmen is doing very well in the context of its debut today. My expectation is that we will continue to see broad participation from the buy side. We've seen it across the recent transactions. What's been amazing to see as well is just how global the buyer base has become. The US has really attracted a lot of interest and capital from global institutions who are looking to deploy it and really high quality businesses. It's never been more global buyer base than it is today, in my experience. And so I expect we'll continue to see more of that. So I'm confident that really the IPO market is more about driving more supply into the market as opposed to creating demand. And with some, hopefully, some continued visibility around the macro backdrop, some solid IPO outcomes, and ultimately trading performance, we'll see more supply that ultimately feeds the buy side.
Tommy, great to have you on set. Thanks for joining us.
Thank you so much.
Appreciate it.
Yeah.
All right, let's check in on a few more trending tickers now. Shares of Unilever, they are lower today after the company reported quarterly earnings and just missing sales expectations for Q4. So analysts weighing in on this one, Julie. I see Citi actually has a buy on this one. They say Q4 results were in line. The print confirms they told clients strength of the model. They do say lack of potential further catalyst until later in the year, with comments on a slow start to the year may temper enthusiasm in the short term.
Yeah, a number of different analysts emphasize that slower start to 2025, and they were concerned that some of the estimates are then going to start to come down for the rest of the year. We should mention Unilever also is planning to spin off and list its ice cream unit, and there was some debate about where that listing was going to be. It's now said it's going to be in Amsterdam, and then London and New York are going to get secondary listings, so it's a triple listing.
A relatively rare new triple listing.
Yeah,
yes.
Exactly. So that was just something that investors were looking at as well today. You love that, the rare triple listing.
I love it. Who doesn't?
Who doesn't love
There's a
a
lot
little
of
ice
Ben and
cream?
Jerry's. Yeah.
Amen. Coming up, we're counting down to the closing bell and the latest round of earnings results. Stay tuned, more market domination still to come.
Now let's get to some calls of the day. Morgan Stanley cutting its price target on Dell, the firm reducing estimates ahead of earnings. So this was interesting. Morgan Stanley cuts the target on Dell. They go to 128. They reduce their estimates ahead of earnings with a more conservative outlook on AI servers given supply chain bottlenecks. They expect a 2026 EPS guide below consensus. Sounds bad, Julie. It sounds bad, but hold on. The analyst then says, he's remaining overweight. He's still a fan. He's still confident. And buyers, he says, on any weakness for a second half recovery. That's what he's looking for. Next earnings, by the way, February 27th.
Where are those buyers today?
Not today.
Not there.
No.
The shares are up about 30% over the last year. Dell has been, a popular buy for folks who are looking to its servers and sort of. It's gotten zhuzhing, I guess. Like it's found some new life because of the AI.
As every CFA says, by the way, zhuzhing.
Sure. They teach that in accounting school. It's gotten a little new life because of the AI trade. So interesting to see this.
I like this line too. This was the money line. He says to his clients, we believe the 2026 setup could be cleaner post-earnings and the Dell could potentially signal quarter-over-quarter revenue and EPS growth for the remainder of the year. That's a post-earnings setup we like, especially calls out current valuation levels.
All right, well, mark your calendars
There
for
you
February
go.
27th then. Well, Bank of America is hitting Kraft Heinz with a double downgrade, the note highlighting a tough path forward for organic sales over the next year. Always like it when there's some self-awareness in these notes.
I thought you were going to say double downgrade.
Well, double downgrade, but the stock is up. Peter Galbo, the analyst over there, he says downgrading the shares on the lows is not heroic, but we struggle to see a path forward to meaningful organic sales improvement over the next 12 months. So he says the company still has a revenue problem, and he says they're still talking about the value of selling potentially Oscar Mayer, but he said they had an impairment in the quarter, so that sale is sort of less of a zhuzh.
He says if packaged food industry volumes normalize, we see KHC as a laggard given portfolio composition. Since the earnings yesterday from them, where the company did forecast full year adjusted EPS and organic sales below estimates, per Bloomberg, we have actually seen 13 analysts have cut price targets.
Wow.
None have raised targets. Stock is down about 20% over the past year.
Although oddly up today.
Yeah.
Who knows?
Wait for them.
Well, As President Trump continues to ramp up his trade war, consumers are bracing for higher prices on a wide variety of items, including many household and personal goods. Which companies, though, are best equipped to handle such uncertainty? Joining us now is Lauren Lieberman, Barclays Managing Director and U.S. Cosmetics, Household, Personal Care, and Beverages Analyst. So, Lauren, you got all the things that could potentially be affected by these tariffs. We want to sort of zero in on the household goods, personal care segment here. And sort of big picture, talk to us how you're thinking about these potential tariffs and how they could affect these companies and how well prepared they are.
Sure, absolutely, and thanks for having me. Obviously been a hot topic, to say the least, over the last few weeks. Companies throughout earnings season didn't offer all that much color. Everyone kind of spoke to it, but at the same time said it's just simply too early to quantify, and we don't know how this is going to go. It's a mixed bag. I mean, we've got companies that have very local supply chains. So some of my multinational companies, like a P&G, during the COVID years, we'll call it, went to great pains to get their supply chain a bit less local and more local and less global, and qualifying more suppliers, more formulas, so they could be flexible, much more flexible than they were back in 2019. We have other companies like a Colgate, a very global supply chain. They do import some into the U.S. from Mexico. They have not quantified it. So it's pretty well a mixed bag.
Let me ask you, Lauren, look at the coverage universe. Colgate, Palmolive, equal weight. Procter & Gamble, equal weight. Kimberly-Clark, equal weight. Are there certain common themes there that would explain that, Lauren? Is valuation, for example, just not overall very attractive here?
Yeah, absolutely. So the common theme is that I'm actually recommending nothing in large cap HPC, and that's been the case since probably September of last year. The reason is that as food has been very challenged, I know in your last segment you just talked about a specific name, the food industry has been challenged, and that's left the HPC sector as sort of the prize spot within Staples. So a lot of investor capital that was looking to be defensive went into my name. So I felt like valuations were very, very challenging. And so we went equal weight on everything, knowing that as we went into 2025, there were going to be big questions, not just around tariffs, but also around currency and the demand backdrop as well. So we've been really cautious, and valuation has been the number 1 driver of that.
What are you seeing also in terms of trade down at this point? I mean, how price sensitive are consumers? Man, I'm a consumer too. We're tired, Lauren, right? We're tired of sort of price increases and prices staying at an elevated level. How is that playing out for these companies?
So it's been really interesting. I think the realities of inflation in the grocery store, the mass market in these categories, has been fairly slow to show through because in a lot of examples, volumes are pretty resilient and more so than you might have expected given the degree of pricing that was coming through. But I am with you in that it feels like everyone's tired and they've hit their breaking point in various ways and at various points in time. I think the December scanner data was very interesting because a lot of these basic household product categories slowed. And one thought was, the consumer wallet was being allocated to gifts, right, to holiday spending. And so people weren't, buying 2 of the laundry detergent, and there was no, sort of pantry stock up that might have happened. So we're seeing it in a pocket in December. We're seeing it remarkably, though, in that there hasn't been a lot of promotional activity. The companies have remained very, very disciplined and are still really leaning much more on innovation to continue to drive consumers to stick with brands and stay in the categories, and that has been the case. But we certainly do see wobbles, and December I thought was a very interesting example of that.
Lauren, I got to ask you about something specific that I read about in one of your notes, and this has to do with Kimberly-Clark, the big diaper maker. Talk to me about Chinese diaper dumping. Now, perhaps unfortunate turn of phrase, but basically what we're seeing is a glut of diapers coming into the U.S. and other markets from China. I guess that is creating some pricing pressure, something I didn't know about. Can you talk to me about how that's sort of playing out?
Yeah, it's interesting, and those are definitely your words, not mine. But I don't mind how you did that. It was cute. So yeah, it's been interesting. There are some small brands in the U.S. that have showed up that you wouldn't know they're from China. They've got cute names. They are featured both at Walmart and Target. You see them, but they're upstart brands that are manufactured in China and have come in, and they have sort of a premium look and feel to the packaging. They feel very modern, and they've been taking share. And so when you look at the scanner data, that there's this loose category called all other, and all other has been the share winner, and it is these brands. The one thing I mentioned in that Kimberly-Clark note is that they shared with me they're seeing that in Latin America as well, that there has been some of these Chinese diaper manufacturers that are now shipping product into Latin America as well, and that's been putting pricing pressure in the market.
Lauren, I'm curious, given the names you cover and the food they're selling, I'm curious how they're talking about GLP-1s.
So I don't cover food. My colleague Andrew Lazar does. I'd say it's I gotta tread lightly here. So what are companies saying on GLP-1s? And I cover the alcohol names. So a mixed bag. You hear some saying, of course it's out there, of course it's a factor. Some companies are talking about innovation and what they're doing to modernize their portfolios and their products on the shelf to have more nutrition forward, nutrition dense products that would work well for consumers that are taking these drugs. You also hear companies saying, sure, it's a factor, but there's also other things going on that are impacting volume, like the wallet pressures that you just mentioned, right? So there's so many things. I feel like I don't call it the easy answer, but GLP-1s are easy to put your finger on as a big structural change as we're all searching to understand why volumes have been soft. But the manufacturers are not really there in terms of saying this is the thing.
Gotcha. Fair enough. Not a straight line.
Thank you, Lauren. Appreciate it.
Okay, my pleasure.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest results from Airbnb, Coinbase, Palo Alto Networks, and many more. Stay tuned for Market Domination Overtime.
closing bell on Wall Street, and now it's market domination overtime. We'll be joined by Jared Blickery to get you up to speed on the action from today's session. I'm going to start with where we ended the day, and we ended the day higher. As we've been talking about, there was some trepidation this morning. We had first a wholesale inflation report that came out on the heels of the CPI report, hotter than estimated, but not raising a lot of concerns, as Josh pointed out earlier, in part because the inputs into core PCE, which is most closely watched by the Fed, did not necessarily accelerate. So that, and then concern about reciprocal tariffs being announced this afternoon. But in fact, we didn't really get reciprocal tariffs being announced this afternoon. We got a memo to study reciprocal tariffs, and we'll hear more on April 1st. So there seemed to be some relief in the market expressed here. We saw that leg up in the Dow. It finished higher, up 343 points, about 0.8%. The S&P 500 finishing at the highs of the session. By the way, just a few points away from a new record close. 615, just over 618 is the record close for the S&P. And the Nasdaq up 1.5% on the session. Let's take a look under the hood now. Jared, what do you got?
Thank you, Julie. Let's go straight to the sector action. And yes, to put things in perspective, things were looking kind of dire yesterday morning at 8:35 a.m., right after that CPI report when stocks were nosediving. But they have climbed back, and not even the tariff news today was able to halt their incline, I should say. Here we have materials leading. That is the number one return that we've seen today, followed by consumer discretionary, then tech, then communication services. These are the three mega cap sectors. Then we have staples. That's another interesting mix, but we have a lot of earnings going on there. And then you get the S&P 500. So you have a mix of a defensive, that would be the staples, and you have the mega caps, and you also have a cyclical stock, or cyclical sector, that's materials, and everything in the green as you see on your screen. Here are the leaders. ARK Invest, so that's small, basically unprofitable tech. That was in the number one position. That was up over 3%. Then you have gambling, Korean stock, Mag 7, Chinese stock, software, cannabis, solar. So that's a pretty broad mix here. And that's just the top line. Oh, down here, what did not do well? We got Bitcoin down just fractionally, along with ITA, and that is the iShares US Aerospace and Defense ETF. Let's move on over to the Nasdaq 100. Guess what? Meta up 19 days straight, as we've been saying, barely climbed into the green on the close there. I'll give you a year-to-date chart so you can see all the green there. And I went through, I was not able to find a single other stock or instrument in history that has closed up 19 times in a row. So that might be a record of its own. And I'll send it back to you, Josh.
Thank you, Jared. Stocks climbing as investors shake off the PPI reading and President Trump holding off on new tariffs for now. The S&P 500 closing near an all-time high. Joining us now is Julian Emanuel, Evercore ISI Senior Managing Director of Equity, Derivatives, and Quantitative Strategy. Julian, it is good to see you. So let's start with the tariffs, Julian, because President Trump making news there in headlines and signed a plan for reciprocal tariffs, friend and foe, Julian, but we delayed the implementation. Apparently now negotiations start. I'm just curious your response, your reaction to that, Julian, as a strategist.
So again, what it comes down to is if you think about the progression of how he's announced the tariffs, what he's trying to do is provide wiggle room for negotiations. And that's exactly what this was. And so from that perspective, when you think about it, I guess the way the news was not as bad as feared, right? And which corroborates the news on inflation this morning, which was not as bad as feared. And then going back to yesterday, where the inflation news was as bad as feared. And the sum total of it is that the market is able to shrug it all off. It's very significant.
Is it justified in shrugging it off, I guess, is the next question. Is it pricing these risks appropriately, Julian?
So Julie, what really you've seen actually surprisingly is that bearish sentiment, as measured by the AAII survey, has risen to the highest level since late 2023, when actually that was the last pivot leg higher in the market. And so part of the issue with the market has been it's very expensive, but it has remained expensive for a year now. And in our work, I'm looking at prior expensive regimes. Expensive can and often does get more expensive, and that regime persists for upwards of 2 years. So you can argue that in terms of valuations, the risk isn't being properly discounted. But what we would say there is that when you think about the mixture of policies, there's also this potential that you could get some sort of geopolitical positivity, which may offset some of the more challenging aspects of tariffs.
Well, and Julian, it's interesting that you brought up that AII survey and the bearishness, because I would say anecdotally, the people we're talking to recently, if not bearish, they're certainly not pounding the table right now. We've talked to the rare person that is doing so. And sometimes that can be sort of a contrarian signal, right? Do you think that that's the case here? I mean, as we mentioned earlier, we're just a few points away from a new record close on the S&P 500.
Right. And look, the fact is if you go back to the day after the election, you have essentially been in this wide swinging range where actually the range itself isn't that wide, 5,800 the low, and sort of right here, 6,100 or a little bit more at the high. But every single day has felt emotional, dramatic, volatile, and net, it's really sort of ground a lot of people down. And frankly, those are the times when you lose your patience and you lose your discipline, that people with more patience and more discipline, are buying. And we think, actually, if you think about it, our favorite theme, the AI theme, is a perfect example of the volatility we've seen in recent weeks that in our mind is a buying opportunity.
Julian, I'm just curious, when you're talking to your clients right now, given all the issues we're talking about, what is on their list of worries?
I think it is two things. Number one, valuations, as I said moments ago, it really are almost the start of every conversation we have. And to us, if that were not to be the case, then we would get concerned about valuations. And then the other thing, of course, is, look, there's so much coming out of Washington on every single front imaginable. The question is, what's the potential impact? And we just don't know the answer to that, which again is why the market has been swinging as widely as it has. But to the plus side, what we did learn this week, based on the economic data and the inflation data, is the Fed is likely going to be a non-issue until June. And if you think about it from that perspective, that's one uncertainty that's taken out of the equation.
Even if it's, higher for longer, isn't necessarily what the market would want. You're right. At least it's stability, right? I would ask, amidst all of this, Julian, is there anything that you're doing sort of as a defensive hedge strategically at all, given that there is so much uncertainty? Even if you have confidence in, say, things like the AI trade, is there defensive money you're putting to work?
Well, we are, and we like optionality here. Now, it has been an easy trade at times. It's been a difficult trade at times, and frankly, with the VIX sort of softening here as we test the top end of the range, it's been a drag. But frankly, the way we see it is that it's there. Options are in place to enable you not to let your emotions get the better of you in these days. When you think about at 8:35 yesterday morning, after the CPI hit, it really looked like the sky was falling, and that lasted about 15 minutes until cooler heads began to prevail. And we think ultimately this sort of 3 steps forward, 2 steps back cadence that's going to try and frighten as many people out with the volatility is how you have to remain disciplined for what we think are higher prices as the year rolls on.
Julian, thank you very much. Great to see you.
Pleasure.
Got to get some earnings now. We're going to start with Coinbase here. Total revenue at the company, $2.27 billion. That is ahead of estimates of $1.87 billion. Earnings per share also well above what analysts had been anticipating. And trading volume at $439 billion ahead of estimates here. The shares are falling here. I'm trying to dig in and see what exactly is going on, Josh. I don't know if you've seen the...
I wonder how much could be. I mean, this stock has been on such a move as well. I mean, it was up more than 100% over the past 12 months heading into this sprint. It was up about 50%, Julie, just from the election, which was a big part of this story, right? I mean, a lot of investors had moved in here hard because they had really seen Coinbase as a winner, with Trump's win as a winner of having a crypto ally in the White House.
I'm looking at the company's outlook here just to run through some of what they're saying. They said first quarter subscription and services revenue will be $685 to $765 million. Not sure what the specific estimates were around that metric. First quarter transaction expenses will be in the mid to high teens as a percentage of net revenue here. And also the company talked about some of their expenses, including here, increasing here, I should say. So maybe that's weighing on things as well, or kind of to your point, after the high flying, maybe an excuse for a little bit of selling here. But we're going to continue to dig in. I mean, Coinbase has been one of the most visible and vocal lobbyists for crypto policy to change in DC. They've gotten pretty much everything they wanted. Now, I guess it's a question of how do they put that to work? How do they take advantage of that? What changes for them on a material basis based on any kind of changes that are happening in Washington?
What's also interesting with that point, though, Julie, is that if you have this sort of friendlier regulatory backdrop and you have allies in the White House, you see how it's good for Coinbase. But does it also mean, okay, the competitive landscape maybe gets more intense?
Maybe.
So I just wonder how, fortunately, we have a very smart analyst.
We do in just a few minutes.
Let's get to more earnings, though, because we got Palo Alto. So let's move through these earnings as well, which is taking a leg lower here. We're down about 4.5%. Looks like Q2 adjusted EPS, Julie, I see 81 cents. That's versus 84 cents, so missing there. I see Q2 revenue 2.3. The street was closer to 2.24. Q3, let's look ahead. They see Q3 adjusted EPS 76 to 77. The street was closer to 80. And for Q3 revenue, they're calling for between 2.26 and 2.29 billion. Street was closer to 2.27. And now for the year ahead, what we're looking for the full year, I see guidance here. Adjusted EPS 318 to 324 is their bogey. The street was closer to 318, and for revenue 9.14 billion to 9.19 billion. They had seen 9.12 to 9.17, but added up, we're down about 4%.
Yeah, and I'm looking into the statement here as well. The buzzword when it comes to Palo Alto, and indeed cybersecurity more broadly, is platformization, right? Getting all your cybersecurity stuff on one platform, and they're using that buzzword and saying that drove the second quarter results. That's according to the CEO Nikesh Arora, saying that basically they had customers adopting technology driven by the imperative of AI, and that helped. And the company says, this reaffirms our faith, what they've been seeing. This reaffirms our faith in our 2030 plans and our $15 billion annual run rate goal.
Yeah, it's interesting. So obviously you want more color just on overall demand environment, enterprise, SMB. It was interesting too, just competitive dynamics, because I saw some analysts saying that the new CEO of Checkpoint seems to be more aggressive in the channel. It'll be interesting whether Aurora gets questioned on that in the call. Federal spend will come up, any sign of budget cuts as well. They'll want his take on that.
All right, let us turn to Airbnb and see how those shares are performing, up by 14% here. This is even as the company's first quarter forecast is below estimates of $2.23 billion to $2.27 billion. Analysts had been looking for $2.29 billion. But the fourth quarter saw strength here. We've been seeing strength in travel demand broadly, looking across whether it is airlines, although the airlines were a little bit choppy, but hotels. Fourth quarter earnings per share, 73 cents, far above the 59 cents that was estimated. And the company's fourth quarter gross booking value, 17.6 billion, that's ahead of estimates. Revenue of 2.48 billion, also ahead of estimates, Josh.
This is a name, it was down about 8%, Julie, heading into this print over the past 12 months, so pretty beaten down. Obviously a great read on overall travel demand. I am curious what they say about margins. That came up in a lot of analyst commentary, just given the plans the company's making to ramp investments in marketing and in products. So I'm sure analysts want more color on the call, what they see now and ahead.
Yeah, definitely. And again, when you look at some of the other companies that they're competing with, we'll see what they have to say about competition as well. Fourth quarter nights booked and also coming in ahead of estimates. The company said it saw growth across all regions, especially in Asia Pacific and in Latin America. So we see that sort of cross-border travel helping matters. Is that pace going to continue in all of 2025? I think that's something that we'll have to watch. We'll also have to see what kind of currency effects because of that international exposure we see for the company. With the strengthening dollar, that's affecting all kinds of different firms. So we'll hear on the call a little bit more color around that.
Stock is surging after hours. All right, coming up, we will get some analyst reaction to the latest earnings from Coinbase and get you caught up on a few other stocks moving on the back of results. Stick around. Much more market domination over time. That is coming up.
Coinbase reporting a revenue beat in the fourth quarter. The company noting a change in the regulatory environment, unlocking new opportunities for Coinbase and the crypto industry. Mizuho America's senior financial technology analyst Dan Dolev is here on set with us for more insights into the quarter here. So, we were looking at the numbers here for Coinbase, and it seems like, they're not terrible, and yet we're seeing the shares pull back here. Is it just because they have had such a run? What's your impression of the results?
Yeah, so look, they crushed Q4. If you compare it with consensus estimates, but that doesn't really matter because the sell side typically is slower to update their numbers than the buy side. So it's a little bit of a mirage, right? So people are looking at this big beat, which is great to see, but everyone on the buy side, which is like the people trading, they already have those numbers in their model. So what matters most, I think, again, this is more interpretation, two things: the take rates, the retail take rates, and February trends. So I can unpack that for you if you want. So take rates actually flat to maybe slightly down, so at about 1.5 percentage point on the retail take rate. That's actually okay. I think the I guess if you're bearish on Coinbase, we're not that bearish. I mean, we actually upgraded Coinbase recently to neutral. So we're not bearish. But if you're bearish on Coinbase, you're like, they're going to have to give discounts. So the fact that the retail take rate is actually flat sequentially, so Q4 to Q3, that's good news. And the February trends, that's another thing. So they're basically saying 750 through February 11th, I think. So if you take that times 2, roughly speaking, that's like 1.5 billion on transaction revenue. I think this, the buy side was probably modeling a little higher. So I think that's kind of the puts and takes in terms of excitement versus disappointment here.
Dan, can I ask you, this stock is up about 50% since the election, right? It's just incredible move. And obviously a lot of people bet this is one of those names that wins from Trump being back in the White House, that wins from having a crypto ally in the White House. What could Trump do? What are the levers this administration could pull that could be tailwinds for Coinbase?
So everyone is hoping and praying in every possible religion for a Bitcoin reserve. I think that would be probably that the crypto industry, and especially Coinbase, and I don't blame them, are lobbying for so deregulation is obviously coming. I mean, you've seen some pretty harsh moves, but I think what could make or break is if the Trump administration actually makes that decision and goes all in, so to say, and announces some crypto reserve. The reason for that is it elevates Bitcoin values, and when Bitcoin values go up, people start trading more. So think of it as the casino. When you see people winning and coming out smiling and dancing out of the casino, you want to go in and check in. It's like, oh, people are getting rich. So that's kind of the dynamic. When people lose money, nobody wants to touch it. So that's kind of how it works.
Well, I'm curious if the Bitcoin reserve doesn't happen. We've sort of been trying to get to the bottom of what other material changes will happen, not with the price of Bitcoin, which recognizing that Coinbase follows it, but with their business. Will they be able to list coins that they weren't able to list under the SEC, or that those were disputed at least? Are there other things in terms of their banking relationships that have started to change with the removal of that rule from the SEC? What actually changes for them?
Listing is huge. I think Chairman Gensler was, very, very prudent in terms of allowing them to list, altcoins, right? That's a nice way to put it.
Yes, I used the other word earlier off camera.
That will take that word we'll use over a beer. But altcoins on TV, right? So this is going to be much faster. They're going to be able to list those coins much faster. Right now they list, I think, over 200 of these coins, and Robinhood, for example, lists 20. So there's actually more upside on Robinhood from listing more coins than on Coinbase, surprisingly, because Coinbase is already there and Robinhood is here. But I'm very constructive on Coinbase as well. So yeah, more coins, faster, just less regulatory issues. Just not feeling like under the gun every day.
Less friction.
Less friction. That's what the crypto industry has felt over the last 4 years. And I think the hope is things will get a little easier down the road.
Daniel, the SEC sued Coinbase, I guess it was 2023, I think. Do you have any line of sight there, or talk to anybody who has line of sight about what the SEC does there, if they drop the case or they settle in a way that's good for Coinbase? Is that even something that comes up when you talk to clients?
It's very, very interesting you say that. The people that I talk to, which are institutional investors, they're not as focused on it. And I'm not a legal expert, but that being said, I can tell you that this particular topic, and maybe the answer is this particular topic has not come up for debate in pretty much since the election. So I think I don't know what the outcome's going to look like, but I think the pressure on the industry is kind of starting to immediately become,
Interesting.
less of a drag.
Dan, I guess the other thing I would ask is, won't they see more competition from TradFi, right, from traditional finance? Because now also the roadblocks are removed for them to be more involved in crypto. Coinbase, of course, is retail driven, so presumably they'll still benefit from retail. But how is that going to play out?
That is an excellent question, because in fact, so if you think about this, you're getting to the core of the issue. So one of the things that we've been highlighting is Coinbase's take rates on average for retail are about 175
What do we mean by
points.
take rates?
So it's the yield. I mean, it's a fancy word, but it's what they charge. So for every $100, they make $1.75 of trading, right? So just take it on average. Robinhood, for example, is about 55, 0.5%. Okay, 0.5%. So those traditional financial companies, right, the Schwabs of the world and all these other guys, they weren't able to really offer crypto trading until now. And to your point, what their strategy could be is they could just come and say, hey, we're going to offer it for free. Just come and trade equities, be our private client. I'll let you trade all these things for free. And then the question is, and this is a good question, does Coinbase have enough of a moat today that people still coming? Because it's a great app. People love to trade on it, right? So there's a lot of value in Coinbase, but I've always said that the pricing is the Achilles heel. It's too high. It hasn't come down yet, which is amazing, but it's too high, and I don't know if it's like sustainable over the long term.
Let me get your specific take on Robinhood, Dan, because they reported yesterday. So revenue more than doubles. The stock's up more than 400% over the past 12 months. What a tremendous move. You say it's still a buy at these levels.
Oh, it's a 10-bagger. Let me tell you why. I mean, over 10 years. Over 10 years. Not my price target is not a 10-bagger right now, but to be clear. But I have upside, but not a 10x upside. But over the next 10 years, this could be a 10-bagger. Let me tell you why. They are eyeing a $600 billion TAM, at least. That doesn't include sports betting, right? So that's incremental to that. Right now, they're doing $3 billion in revenue. So say they have 5% market share of that 600, that's 30 billion. So if over the next 10 years, they can actually go from 3 to 30, that's 10x. And they're actually, it's not just a pie in the sky, they're actually executing. So, I mean, funded accounts are up almost 2 million year over year, 900,000 sequentially. Assets under management are up 90%, 7x growth in their retirement. So good things are happening, and they're getting into Asia, they're getting into Europe, and they're more broad-based. The reason we still prefer Robinhood over Coinbase, even though I'm constructive on Coinbase, is because it's more diversified and it's a global brand. So you go to like Europe, you go to Asia, people know Robinhood, partly because of what happened in 2021, but it doesn't matter, right? People know it, and millennials love it. It's a great, they really perfected gamifying trading, and young people love to do that. So
biggest risk for Coinbase?
Over the medium term, I just think more. This is the fear. The fear is, I mean, obviously crypto values or Bitcoin kind of starting to go the other way, which we can't predict. But the bigger one is just competition. You're going to get, because of deregulation, to your point, you're going to get the traditional guys come in, some of the kind of Coinbase lookalikes trying to come in, and there might be a time where those take rates, those yields or spreads might be under pressure. Hasn't happened yet, which is a very positive thing for Coinbase.
Dan, great to see you on set. Thank you for stopping by.
Anytime.
All right, shares of DraftKings. Let's get to that name. They are higher following their latest earnings results. The company topped expectations on the bottom line and raised the low end of their full-year revenue outlook. Let me get you those numbers. So it looks like DraftKings Q4 adjusted EPS, Julie, 14 cents. The street was at 11 cents. Revenue, $1.39 billion. The street was at $1.39 billion. But looking ahead, let's see what they're talking about for 2025. They reaffirm 2025 adjusted EBITDA guidance, it looks like. They see 2025 revenue 6.3 to 6.6. They had seen 6.2 to 6.6 billion.
So raising the lower end of that full year forecast, it looks like that is helping matters here for DraftKings. And, coming off of betting season.
I was recently talking to JMP's Jordan Bender, smart guy, knows the sector well, friend of the show. I wanted his kind of just take on the overall sector now that the Super Bowl is behind us. And it was interesting, we talked about DraftKings and floated how he was overall constructive because now, as he said, we roll into March Madness. We got the start of baseball season. Comps, he said, should get easier for these names. So overall, optimistic.
I mean, DraftKings hasn't done a heck of a lot. The shares are up like 9% over the past year.
About 10% of the past 12 months? It's not. No, we're popping here in the after hours.
Yes.
All right, let's take a look at a few other stocks that are trending here after hours. Shares of Applied Materials, they are lower despite being analyst expectations on their first quarter earnings results. The manufacturing company issuing some weaker than expected guidance for the second quarter as Applied Materials sees net sales of about $710 billion for the quarter, while the street was estimating $7.22 billion.
Wynn Resorts getting a boost after hours. That company reported adjusted earnings per share for the fourth quarter that beat the average analyst estimate. We also saw operating revenue for the quarter come in well above expectations.
And shares of Roku, they are surging on fourth quarter results. The company reporting a narrower loss than expected, loss of 24 cents versus the estimate of a 40-cent loss. Net revenue also coming in better than analysts anticipated. Roku's first quarter net revenue guidance matching the street's expectations. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. Stay tuned for Asking for a Trend right on the other side. Welcome to Asking for a Trend. Cloud data management company Informatica reporting fourth quarter earnings just moments ago. And here to help us break down the report is Informatica CEO Amit Walia. Amit, it is good to see you. So let's get right to the results, Amit. So Q4 adjusted EPS 41 cents. That was a beat, Amit. Q4 total revenue 428.3. That was a bit light relative to expectations. The annual revenue forecast, Amit, that looks like it did miss what analysts had been expecting. So walk us through the quarter, the report. What are you seeing in the business, Amit?
Well, Josh, thank you for having me, as well as Julie. Look, I think it was definitely a quarter where we did not anticipate and did not meet the results that we had planned for. And look, many of things that happened that were operational challenges, but also many great things happened. So to the question you asked, look, we ran into two core issues. One is that the renewal rates of our cloud and some of the non-cloud business did not meet our expectations. So that reduced the annual recurring revenue. And on the other side, a good thing became a headwind. We actually had a lot more of our on-prem customers wanting to modernize to cloud, but that creates an accounting hiccup where basically we lose some of the on-prem revenue a lot faster, and we don't fully recognize the cloud ARR. So that created one of those accounting challenges where we could not get the upside, but we got some of the roll-offs a lot faster. So that also led to some of the ASC 606 revenue, a lot of accounting stuff, but that's where we missed what we were anticipating to deliver.
And let's take the first part of that obstacle as well, the one that didn't turn into something more positive. What do you think accounted for slower signings, and what are you seeing in the current quarter so far?
Julie, let me step back. Actually, even if that happened, we actually had a very strong quarter in a lot of other ways. And I know in a time like this, it may seem a little bit difficult to say. Our cloud business grew 34%. We expected it to grow more than that, but ending at $827 million of ARR, there is nothing to sneeze at. And the raw demand actually remained very healthy and strong. Where we missed was operationally on some of the renewal side of things. We know very well what to do. We have baked that for this year in terms of work to do, and we will feel good about as we come out of it. But raw demand was good for us. And you can see that even as we think about next year, we are guiding our cloud business to be $1 billion ARR, growing at about 25%, which is a substantial amount of growth because we are still growing faster than our market.
Amit, I'm curious, how the macro could factor into this. Listen, you've got a lot of customers in a lot of places. How do those customers generally feel right now, Amit? Are you picking up optimism, confidence, spend, or no, they're getting cautious, they're in cost-cutting mode? What are you seeing?
Look, we did not see any change in the raw macro demand coming in. Like I said, our pipeline creation and our raw input of net new business was pretty fine. Actually, to be honest, as I said, it's more of operational work for us to do. Of course, customers are looking to tiptoe their way into more production Gen AI use cases, very, very early innings. We see that more towards the end of this year. But we see work happening in terms of POCs and experiments and so on and so forth. But it's not like we are seeing cuts in general. As I said, this is something that we expected a lot higher from us, much, much more faster than the industry. And we kind of didn't anticipate where we ended up.
Do you think that the big spending commitments that we were seeing on the part of the hyperscalers, for example, is reallocating resources away from things like cloud, maybe more towards generative AI? And what is all of that meaning for your business?
Well, some of that spend that you're seeing is also CapEx, Julie. Right. So that is different part of the spend category than where we are. In fact, if I step back, we actually have 100 customers actually working with our platform to do Gen AI workloads. Obviously, more in POC and pilot phases, and we expect them to get to production towards the course of this year. These are healthcare companies, pharmaceutical companies, insurance companies, biotech companies. So we are seeing good traction over there. So we see Gen AI in enterprise from a data point of view still in its early innings because production takes a lot of work. The stuff that you're talking about is a lot of CapEx build out that is obviously a different part of the tech stack.
Amit, if somebody's looking at your stock, not just today, because we're seeing this negative reaction in the shares, but over the past 12 months, the slide that we've seen, what would you say to a potential investor that would seal the deal and you say, we want you to be an owner of our shares? What do you think is really the key value proposition here?
Well, look, I think any day like this can be a difficult day. But if I step back, to me, $1 billion cloud business growing mid-20s from a guidance point of view, and overall a company that has 32, 33% non-GAAP operating margin and cash flows is a pretty strong place to be. And look, we were growing. We had a much higher aspiration of growth. We have operational work to do. So we have taken that adjustment for this year. We believe we know what to do. We have work to do, and we'll go make it happen. We've done that before many times. I feel very good about it. And I think it's a matter of seeing what we have created innovatively under the cover, still being the leader in our space on raw innovation. And I feel very good about the intrinsics of that business.
Amit, I know joining on a day like this, can be tough. So we appreciate your time and your insight. Thank you so much.
Well, thank you for having me. I appreciate it.
Time now for What to Watch Friday, February 14th. Starting off on the earnings front, we're going to be getting some more reporting from Moderna and Enbridge in the morning. Moderna announcing results for the fourth quarter before the opening bell. The pharmaceutical company is getting a couple of downgrades over the last few weeks. Investors will also be listening closely for any commentary on the call about the confirmation of Robert F. Kennedy Jr. as Health and Human Services Secretary and how that could impact the company going forward.
Taking a look at the economy, U.S. retail sales numbers for January will be coming out in the morning. Economists forecast sales will decline 0.2% on a month-over-month basis. That'll mark the first monthly decrease since August.
And moving over to the Fed, we're going to be getting some more Fed commentary from Dallas Fed President Lori Logan in the afternoon. This is coming after Fed Chair Jerome Powell wrapping up 2 days of congressional testimony yesterday. Powell urging patience on interest rates, saying inflation needs to slow down before more cuts. Stick around, much more Ask for a Trend still to come.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
U.S. stocks closing higher as President Trump delays implementation of reciprocal tariffs. And Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Yeah, Josh, so we were waiting for some tariff news, and we got a little bit of tariff news, but it wasn't a big market mover. I feel like we really probably got the direction of the market in the morning. So I want to start with the producer price index, one of the key inflation readings we had, Josh. So it came in above expectations, but when you look under the surface of both the producer price index and the CPI index, the key takeaway was there was some good news for the Fed. And what we're talking about in terms of good news for the Fed, PCE, the Fed's preferred inflation gauge. We were talking about this yesterday. A lot of acronyms, but PCE comes out later this month. That's what the Fed looks at. Here's your January estimate now after taking out the components of CPI and PPI that lead into PCE. Economists think that prices increased 2.6% year over year in January. You can see moved down from 2.8% that we saw in December. Realistically, a relatively good sign in terms of inflation. So this week, yes, we've had some hot prints, but it certainly seemed like the market liked what was underneath the surface in terms of PPI today.
So PPI, PCE, how did the market take it all in? What did the market make of this data?
So yesterday, Josh, we talked about that big move up in the 10-year, right? We were at, I think it was as high as 4.66. Look at where we are today, 4.53. So let's go to a 3-day on the 10-year, and you'll see here's your CPI jump. Here's your PPI dump down. We're back where we started the week. And as we've talked a lot over the past month, when yields are falling, it's been a pretty good environment for stocks, right? So the S&P 500 up about 1%. Your interest rate sensitive Russell 2000 actually outperforming the S&P 500 today. You saw a pretty broad-based rally. Also some interest rate sensitive sectors sort of react to this news, pick back up. So it seems like we maybe overreacted to the CPI report and then just unwound it all today. And we're coming out of it with, maybe inflation is going to be a problem, but it's hard to tell right now at this point.
All right, take the All right, Schaefer, point number 2.
Number 2, it is not all about the Mag 7 in 2025. So here we're looking at, this was a chart from our chart book via Rich Bernstein. We added this line. So this is stocks outperforming the S&P 500. Initially, the take was over 2023 and 2024. There was the least amount of stocks outperforming the index in 25 years. If you look at how low these bars are, you'd have to go all the way back to the dot-com bubble to see that few amount of stocks outperforming. Well, now we're at almost 50%, which is the long-term median over the last 30 years. And so what's interesting, Josh, when you think about stocks outperforming, as I said, you flip over to who is outperforming, who's above that 4% for the S&P 500. And there's only one Magnificent Seven company, two Magnificent Seven companies. Amazon's narrowly beating, but Meta jumps out, right? Meta is sort of the key one. But the stock that's leading the S&P 500 thus far this year, Palantir.
Yeah.
So it's interesting to see perhaps a little bit of an AI shift in terms of what's been outperforming.
I was going to ask you that, just if you were looking at the sort of trends or themes of outperformance, what you would be calling out.
Yeah, so I'm going to flip over to our AI screen here, and we're going to stay on a year to date, and I'm going to equal it out for us, and we'll be able to see some of the bigger names that are also in the S&P 500. So you take a look here, Supermicro, CrowdStrike, again, Meta. We already highlighted Palantir, but we've talked a lot about that shift in AI trade from the infrastructure chip stocks to these software stocks that can sort of sell AI as a service. You're definitely seeing that. And the other thing I'll highlight too, you're just seeing a lot of catch-up trade to some extent, right? So if we look over the last year at, say, Supermicro Computer, didn't do too well then last year, right? So you're starting to see a little bit of catch-up there. I'll highlight CrowdStrike too. Remember they had that glitch last July. You could see the big dump there. Look at what the stock's done since. It's been a little bit of a chase and a catch-up trade in some of these names that's been helping lead the index higher. But overall, right now, there's plenty of places for investors to find stocks that are outperforming the S&P 500, which if you're a stock picker is a little bit more of a fun environment than the last couple of years.
For sure. Joshua, thank you. Appreciate it. The Eagles will be celebrating a championship tomorrow through the streets of Philadelphia, but they aren't the only big winners of Super Bowl 59. And joining us now is Joe Popliano, Yahoo Finance Sports Report host. Joe, always great to see you. I want to start here, Joe, because I'm curious to get your thoughts. What do you make of how Fox did with this Super Bowl, Joe? Overall, what grade would you give them?
Yeah, thanks for having me, Josh. I would give them an A+. I mean, if you think about from a viewership perspective, they set an all-time Super Bowl record with 126, 127 million viewers. Now, I think it's important for the audience to know that these numbers are a little bit skewed, right? If you think about how viewership has been measured over the years, Nielsen has certainly changed the formula by adding out-of-home viewership a couple of years ago, and then they expanded that from 65% of the country to 100% coverage of the country this past year. Tubi also contributed 13 million viewers to that total viewership number. But more impressive is what Fox was able to do on the advertising side. If you think about last year, CBS brought in $700 million, roughly, of advertising revenue from the Super Bowl. That game also went into overtime, where they were able to make about $60 million in additional ad revenue on top of the $635, $640 million that they had before that. So $700 million total for them last year. This year, Fox only had, call it 5 million more viewers, but got to $800 million in ad revenue. So their ad sales team did a phenomenal job. They were charging some brands $7 to $8 million even for ad slots. About a dozen companies were able to pay that top rate. $800 million for one game, considering they paid the NFL $2.2 billion this year for over 100 games, is pretty good.
Joe, I also want to talk about some of the pretty buzzy ads that we talked about on this show, the commercials. Here's a peek for the audience at the newest episode of your podcast with Nick Primola, Association of National Advertisers Group Executive Vice President.
I look at something like a Google, a Gemini AI, right, where you've had there wasn't anything particularly special from a consumer standpoint about the spot. However, as an industry executive, and what we're looking at is what they've actually been able to do using their own technology, their own AI. You hear a lot about AI. They ran 50 different spots using AI, 50 different versions of a spot using local businesses who are using Google Gemini. And in that case, it really is like a flex to the industry saying, look what you can do as a brand, using our technology or using AI. And then it's showing the consumers, actual small businesses in their markets using AI to grow their business. So it had that sort of double bottom line. And from a geeky industry standpoint, that was really attractive to us.
So Joe, on the ads, it was interesting to get your take because some of the response, the reviews of the ads the next day, kind of lukewarm, Joe. But what did you think?
Yeah, I think brands have started to play it safe over the last number of years, right? There's less funny commercials or jokes inside the commercials. A lot of them are just leveraging celebrity endorsements to get an ad out there. And what we've also seen is that a lot of these brands are now debuting their ads before the Super Bowl, right, to maximize impressions on social media. But it's working. I mean, Nick told us during that conversation that these brands were seeing an 8.5x return on their investment that they paid. So $8 million for an ad sounds like a lot for a 30-second commercial, but that number will probably even go higher over the coming years. Final question here, Joe, just switching gears. YouTube TV customers might miss some pretty huge sporting events if it and Paramount can't come to a new agreement on carriage fees. Your thoughts on that one? Yeah, I think people are just frustrated with YouTube TV, right? If you think about the last number of years, they've hiked the price 4 times. It started at $35 in 2017. It's now up to $84, $85 now per month. So that's obviously a huge price increase. But on the other side of that, they haven't really given more value for that price increase, right? They got rid of MLB Network. They've ditched the regional sports networks. And now, like you mentioned, they have this carriage dispute with Paramount, which could lead to CBS being lost from the channel before March Madness and also the Masters tournament. I don't necessarily think that's going to happen. I mean, it might happen for a couple of days or something like that, but it's too big of a risk with March Madness and the Masters. Paramount doesn't want that. YouTube TV doesn't want that. But I think on the flip side, people are just upset about how much the prices increase, and they feel like they're getting a product that probably isn't as good as it was a couple of years ago. Joe, always great to see you. Always great to have you on the show. And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report that drops every Thursday at 5 p.m. Eastern. Stay tuned. More Ask for a Trend right on the other side.
Let's take a look at what's trending now after hours. Check out shares of GameStop, jumping nearly 20% after hours. The company reportedly considering investing in Bitcoin and other cryptocurrencies. That's according to CNBC. That news coming just days after GameStop CEO Ryan Cohen posted a photo of himself with strategy executive chairman Michael Saylor, who has, of course, used that same strategy at his company. The report says GameStop could reverse course on this move. Twilio slightly missing earnings estimates for the fourth quarter. Looking ahead, the company forecasting profits for the first quarter below Wall Street expectations. Twilio also did reiterate the financial targets announced at its investor day. And Dexcom reporting fourth quarter revenue that met expectations, growing 8% year over year. Meanwhile, the company reiterates its fiscal year 2025 guidance for revenue, falling shy of analyst estimates. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.